18.3 billion euros.
That's how much was missing. Not misplaced, not mismanaged, missing. As in never there, as in fabricated out of thin air, built on forged documents, phantom bank accounts, and a web of lies so elaborate it would take forensic accountants 3 years just to map it all out. Picture this. It's December 19th, 2003. In the quiet, wealthy city of Parma, Italy, the gastronomic capital of a nation obsessed with food, a phone rings at Bank of America's offices. On the line is an auditor from Grant Thornton, asking for a routine confirmation. Just a simple request. Can you verify that Parmalat's Cayman Islands subsidiary, Bonlat Financing Corporation, holds 3.95 billion euros in cash in account number 001-608-000-000? The Bank of America executive checks the system, then checks again, then feels a cold sweat forming. That account does not exist, he says. That account has never existed.
In that moment, Europe's largest corporate fraud, bigger than Enron, more complex than WorldCom, more audacious than anything the continent had ever seen, begins to unravel.
But here's what makes this story truly terrifying. Parmalat wasn't some fly-by-night internet startup. It wasn't a cryptocurrency casino or a SPAC with no revenue. Parmalat was milk. It was the milk that millions of Italian children drank every morning. It was the yogurt in your grandmother's refrigerator. It was the company that sponsored your favorite soccer team, that employed your neighbor, that represented the very best of Italian industry. Family-owned, quality-obsessed, built from nothing into a global empire. For 40 years, Calisto Tanzi, the founder, the visionary, the devout Catholic who walked to Mass every Saturday with his family, had been the godfather of Parma, literally. When his private jet flew over the city, locals called it l'aereo di Dio, the airplane of God.
And God, it turned out, had a secret.
A $14 billion secret.
That number, 14 billion euros, roughly $20 billion at the time, represented more than just missing money. It represented the total and complete corrosion of trust. It meant that every financial statement Parmalat had issued for over a decade was a work of fiction. It meant that the auditors who signed off on those statements were either complicit or catastrophically incompetent. It meant that the world's largest banks, Citigroup, Bank of America, Deutsche Bank, Morgan Stanley, had structured elaborate financial transactions specifically designed to help Parmalat hide its debts while generating millions in fees. Most terrifying of all, it meant that the system, the entire apparatus of global finance, with its auditors and regulators and credit rating agencies and sophisticated institutional investors, had looked at a company claiming to have billions in cash while simultaneously borrowing billions more and seen nothing wrong. This is the story of how Europe's milk empire curdled into history's most expensive dairy product. A story of greed, manipulation, family corruption, and media silence. Of fake bank accounts in the Cayman Islands, forged documents on Bank of America letterhead, and a family so entrenched in power that they treated a publicly traded multinational like their personal piggy bank. Welcome to the story of Parmalat, where Italy's most trusted brand, the company that made milk that lasted for months without refrigeration, that sponsored Formula One racing, that owned a football club beloved across Europe, was rotting from the inside while everyone celebrated its success. This is a story about greed disguised as ambition, about corruption wrapped in patriotism, about how a college dropout from a small town near Parma built a dairy empire on his father's grocery store and then destroyed it with lies when he couldn't admit it was failing. This is crime in the corporate boardroom. Fraud signed off by auditors who should have known better. Bankers who made millions facilitating transactions they never questioned. Politicians who accepted campaign donations and looked the other way. And at the center of it all, Calisto Tanzi, the grocer's son who became a billionaire, the entrepreneur Italy celebrated, the fraud the world condemned. Buckle in, because this story moves from a small pasteurization plant in Parma to offshore tax havens in the Cayman Islands, from Milan courtrooms to New York federal lawsuits, from Formula One glory to prison cells.
This is how Europe's milk empire curdled into its biggest bankruptcy. This is how trust turned toxic. This is how one man's refusal to face failure destroyed lives across multiple continents.
Let's pour ourselves a glass of milk, or maybe something stronger, and talk about the fraud that changed European finance forever. Calisto Tanzi was 22 years old when his father died.
Born November 17, 1938, in this small town just outside Parma, Calisto had been a university student, studying business, building a future, escaping the modest circumstances of his family. His father, Melchiorre, ran a small grocery store. Respectable, stable, nothing glamorous. Then Melchiorre died suddenly, and as the eldest son, Calisto faced a choice: continue his studies and let the family business fail, or drop out and take over.
Italian family duty 1. Calisto quit university, took over the grocery, and immediately hated the limitations.
Running a family grocer was fine for his father's generation, but Calisto had ambition, vision. He looked at the dairy products in his store: milk that spoiled in days, cheese that needed refrigeration, products that had to be sold fast, and saw an opportunity.
What if you could make milk last longer? What if you could pasteurize it in a way that kept it shelf-stable for months? You could ship it anywhere, sell it across Italy, export it globally.
In 1961, with money scraped together from family and local investors, Calisto opened a small pasteurization plant in Parma. He called it Parmalat, a combination of Parma and latte, milk in Italian.
The innovation was ultra-high temperature UHT processing, heating milk to extreme temperatures to kill bacteria, then packaging it in aseptic containers that kept it fresh for months without refrigeration. Europeans had never seen anything like it. American GIs brought back memories of canned milk from World War II that this was different. This tasted fresh.
Parmalat milk could sit on a shelf for 6 months. You could buy it in bulk, store it in your pantry, never worry about it spoiling.
Italian housewives loved it, retailers loved it, and Calisto Tanzi suddenly had a product that could scale beyond Parma.
The 1960s and 70s were good to Parmalat. The company expanded across Italy. By the late 70s, Parmalat was exporting to dozens of countries. The distinctive tetrahedral carton, a pyramid-shaped package designed by Swedish company Tetra Pak, became instantly recognizable. In 1978, Parmalat became the title sponsor of the Brabham Formula One racing team. The logo blazed across cars driven by legends like Niki Lauda and Nelson Piquet. Formula One was prestige, glamour, international visibility.
Parmalat wasn't just a dairy company anymore. It was a symbol of Italian industrial success.
In 1990, Parmalat listed on the Milan Stock Exchange. The IPO was a triumph. Investors poured money in. The valuation climbed. Calisto Tanzi, the grocer's son who dropped out of university, was now running a publicly traded multinational corporation, and he was hungry for more.
Throughout the 1990s, Parmalat went on an acquisition spree. Bakeries, beverage companies, food producers across South America, North America, Australia, Asia. The company bought Parma Football Club, one of Italy's storied soccer teams. It purchased a travel company called Parmator.
It bought Odeon TV, trying to rival Silvio Berlusconi's media empire.
By April 2002, Parmalat employed over 30,000 people in 30 countries. The stock hit record highs. The company was valued at 3.7 billion euros.
Calisto Tanzi was a billionaire, a knight of the Italian Republic, Cavaliere del Lavoro, honored by the government for his contributions to Italian industry.
He moved in elite circles. Politicians courted him. Banks competed for his business. He was proof that Italian entrepreneurs could build global empires.
But behind the gleaming success story, something was rotting.
Here's what nobody knew. Most of Parmalat's acquisitions were disasters. The football club? Money pit. Paying players' salaries, buying stars, trying to compete with richer clubs. It burned through cash. Parmator failed. The travel industry was competitive. Margins were thin. Parmalat had no expertise.
Odeon TV, catastrophic. Tanzi spent 130 million euros buying it, sold it for 30 million euros, a 100 million euro loss, and Tanzi had personally guaranteed debts on the purchase. The South American operations, many were losing money. The acquisitions had been done hastily, without proper due diligence or integration plans.
But admitting failure wasn't in Calisto Tanzi's vocabulary. He'd built Parmalat from nothing. He'd proven skeptics wrong before. He wouldn't acknowledge that his empire was crumbling. So he lied.
And when the lies got too big to manage, he lied more. Bigger lies, more sophisticated fraud, layer upon layer of deception to hide the simple truth. Parmalat was deeply, catastrophically unprofitable.
By the late 1990s, Parmalat was a financial zombie, appearing alive, looking successful, but sustained entirely by fraud.
Bonlat Financing Corporation existed only on paper. Incorporated in the Cayman Islands, that tropical paradise for shell companies and tax avoidance, Bonlat was supposed to be a simple holding company, a subsidiary that managed some of Parmalat's international operations.
In reality, Bonlat was Parmalat's graveyard, the place where debts went to be buried, where losses disappeared, where billions in liabilities were hidden from auditors, investors, and regulators.
And critically, Bonlat was where Parmalat kept its fake money.
By 2002, Bonlat's balance sheet claimed it held 3.95 billion euros in cash and marketable securities at Bank of America in New York. Nearly $5 billion, just sitting there, safe, liquid.
It was Parmalat's safety blanket. When analysts questioned why the company was issuing new debt despite claiming to have billions in cash, executives pointed to Bonlat. We have the money. It's in the Caymans. We're keeping it offshore for tax purposes. Nobody checked. Why would they? Bonlat's auditors, Grant Thornton International, certified the financials. Bank statements appeared legitimate. Everything looked fine. Except it was all fake. Parmalat's fraud involved multiple interconnected schemes, each designed to create the illusion of profitability.
Scheme 1, the fake Cuban milk trade. In the late 1990s, Parmalat claimed to be selling massive quantities of milk powder to Cuba via a Singapore-based producer. Hundreds of thousands of tons, millions in revenue. The milk didn't exist. Singapore had no such producer. Cuba bought nothing.
Parmalat created fake invoices, fake shipping documents, fake payment records. The revenue from this fictitious trade appeared on the books. The accounts receivable became assets, money that would supposedly be collected eventually.
Except there was nothing to collect. It was pure fiction.
Scheme 2, double billing and circular transactions. Parmalat would sell products to its own subsidiaries, then record those internal sales as external revenue. The subsidiary would show it owed money to the parent company, creating fake receivables.
Then Parmalat would move money between shells to pay these fake invoices, creating the appearance of cash flow. Money would circle through offshore companies back to Parmalat and get counted multiple times as different assets.
As many as 300 people inside Parmalat knew about the double billing scheme. They knew, and they stayed silent. Because corporate culture at Parmalat made silence mandatory. Questioning the numbers meant questioning Calisto Tanzi, and nobody questioned Calisto.
Scheme 3, credit-linked notes to itself. This one was elegant in its absurdity. Parmalat sold credit-linked notes to itself. Essentially, the company was betting on its own creditworthiness, then counting that bet as an asset. It was like writing yourself a check, depositing it, and claiming you had more money.
Auditors should have caught it. It violated basic accounting principles. But complexity was Parmalat's weapon. The corporate structure was so labyrinthine, 214 subsidiaries in 48 countries by 2003, that tracing money through the web was nearly impossible.
And when auditors asked questions, Parmalat provided forged documents.
The crown jewel of Parmalat's fraud was the Bank of America account.
In 2002, when auditors asked for confirmation that Bonlat held 3.95 billion euros at Bank of America, Parmalat provided a letter. Official letterhead, bank signatures, account details. Everything looked legitimate.
The letter was a forgery, complete fabrication. Parmalat executives had created it themselves, copying letterhead, forging signatures, inventing account numbers.
The auditors, Deloitte Touche at Parmalat, Grant Thornton at Bonlat, didn't verify directly with the bank. They sent confirmation requests through Parmalat. The company intercepted them, created fake responses, sent them back to the auditors.
It was shockingly simple, and it worked.
Until November 2003, when everything started unraveling.
Looking back, red flags were everywhere.
In 1997, Grant Thornton found a €5 billion hole in Parmalat's records during an audit. They raised concerns. Tanzi and CFO Fausto Tana assured them it was a paperwork issue. The auditors accepted the explanation.
Merrill Lynch analyst Gianfranco Cocconcelli issued a sell rating on Parmalat stock in 2002. He was one of only 2 analysts out of 29 covering the company who questioned the numbers. Everyone else rated it buy or hold.
In early 2003, Deloitte refused to sign Parmalat's half-year financial statement because they had doubts about a €135 million gain from a derivatives contract with Epicurum, another Cayman Islands fund linked to Parmalat. The gain seemed fabricated.
CFO Fausto Tana suddenly announced a €300 million bond issue in February 2003. This surprised even CEO Calisto Tanzi. Why did a company claiming to have billions in cash need to issue expensive debt? Tanzi forced Tana to resign, replaced him with Alberto Ferraris, a former Citigroup banker. Ferraris took the job excited about running a major European corporation's finances. He had no idea what he was walking into.
Alberto Ferrari started asking uncomfortable questions immediately. As CFO, he should have had access to all the books, but he didn't. Chief Accounting Officer Luciano del Soldato controlled access to certain records. When Ferraris asked to see documentation for the Bonlat account, for the Epicurum fund, for various offshore holdings, he got stonewalled. I was surprised to discover that, though now CFO, I still did not have access to some of the corporate books, Ferraris later told Time magazine.
By October 2003, Ferraris had pieced together enough to know the company was in serious trouble. The debts were massive. The assets were questionable. The offshore accounts didn't add up.
He went to Calisto Tanzi, face to face, CFO to chairman, expecting Tanzi to say there must be a mistake in Ferrari's calculations.
Instead, Tanzi shrugged. 8 billion, 11 billion, 14 billion. It's all the same, Tanzi said. Ferraris was flabbergasted, stunned. The founder of one of Europe's largest companies had just casually admitted that the debts were catastrophically bigger than disclosed, and he didn't seem to care about the exact number.
Ferraris urged Tanzi to call an emergency meeting with banks, come clean, try to restructure, find a solution.
Tanzi refused, and Ferraris quit. A few weeks later, everything collapsed.
because the lies had finally grown too big to sustain, and when they fell apart, they fell fast.
The dominoes started falling in November. Consob, Italy's securities regulator, was investigating the Epicurum Fund. The 135 million euro derivatives gain that Deloitte had questioned, it looked increasingly fake. Consob demanded answers.
They ordered Grant Thornton, Bonlat's auditor, to verify that the 3.95 billion euros supposedly held at Bank of America actually existed.
Grant Thornton sent a confirmation request, not through Parmalat this time, directly to Bank of America. The response came back quickly, unambiguous, devastating. No such account exists. Bank of America had no record of Bonlat, no account, no $3.95 billion, nothing. On December 8, 2003, Bank of America publicly disavowed the document Parmalat had been using to prove the account existed. The bank notified Grant Thornton that the letter was a forgery. Parmalat's stock price immediately began crashing, down 40% in days. Calisto Tanzi resigned as chairman and CEO on December 15th. The board appointed Enrico Bondi, a restructuring expert, as extraordinary commissioner, giving him emergency powers to try to save the company. Bondi brought in PricewaterhouseCoopers to audit the books, get a clear picture of reality. What they found was worse than anyone imagined. Parmalat issued a press release that made financial history. The company announces that it has discovered that assets in its 2002 audited financial statements were overstated by at least 3.95 billion euros. The biggest asset on our balance sheet doesn't exist. We lied for years.
The stock crashed to zero. Trading was suspended. Investors who'd held Parmalat bonds, more than 135,000 small Italian savers who trusted the company with their life savings, watched their wealth evaporate.
Within hours, Parmalat subsidiaries around the world started failing. The Brazilian operations went insolvent. The Argentinian operations collapsed. The American subsidiaries filed for bankruptcy. Parma Football Club faced liquidation.
The company that had claimed to be worth billions was revealed as a financial corpse, kept walking through fraud. Parmalat officially filed for bankruptcy protection, 14.3 billion euros in debt, almost 8 times what the company had originally disclosed. The same day, Italian police arrested Calisto Tanzi. He was taken to Milan's San Vittore prison, the same prison that once held Mussolini. Medieval walls, harsh conditions, a far cry from the luxury Tanzi had known as a billionaire businessman.
During questioning, Tanzi admitted there was an 8 billion euro hole in Parmalat's accounts, but he denied orchestrating a cover-up, claimed he didn't know how bad things had gotten, blamed subordinates.
Nobody believed him.
Within days, more arrests followed. CFO Fausto Tona, Chief Accounting Officer Luciano Del Soldato, 2 executives from Grant Thornton's Italian affiliate, managers who'd helped create the fake documents. Eventually, 29 people would face criminal charges in Milan, more in Parma.
The Parmalat collapse sent shockwaves far beyond Italy. The U.S. Securities and Exchange Commission filed a lawsuit on December 30th, calling it one of the largest and most brazen corporate financial frauds in history. American investors had bought over $1.5 billion in Parmalat bonds based on fraudulent financial statements.
International banks that had helped Parmalat issue bonds faced scrutiny. Had they known? Should they have known? Why didn't they verify the financials before helping the company raise billions? Bank of America, Citigroup, Deutsche Bank, UBS, Morgan Stanley all faced investigations. Some would eventually settle for hundreds of millions in damages. The auditors were in the crosshairs. Grant Thornton had certified Bonlat's financials, including the fake Bank of America account. How did they miss a forged bank letter?
Deloitte had audited Parmalat's parent company financials. They'd raised some concerns, but ultimately signed off on statements that were fraudulent.
In 2007, Deloitte settled with Parmalat for $149 million. Grant Thornton fought lawsuits for years before settling for $4.4 million. The amount seemed inadequate given the scale of fraud they'd failed to detect. Behind the billions in debt were real people whose lives were destroyed. Over 135,000 small Italian investors, many of them retirees who'd put their life savings into Parmalat bonds because they trusted the company, lost everything. Entire families financially ruined overnight.
The 36,000 Parmalat employees worldwide faced uncertainty. Many lost jobs as subsidiaries collapsed. Those who kept working watched their pensions get slashed as the company reorganized under bankruptcy protection.
Suppliers who'd done business with Parmalat for decades, dairy farmers, packaging companies, logistics firms, went unpaid. Some went bankrupt themselves. And across Italy, a sense of national shame settled in. Parmalat had been a source of pride, an Italian company competing globally. Now it was synonymous with fraud, Europe's Enron, a cautionary tale about corporate governance failures.
In prison, facing the weight of evidence, Calisto Tanzi began admitting pieces of the truth.
He confessed to diverting approximately 500 million euros from Parmalat to cover losses at Parma Tour, his failing travel company. He admitted using Parmalat funds to pay off personal debts on Odeon TV. He acknowledged that the offshore structure was designed to hide losses. But he maintained he'd never intended to defraud investors. He claimed he'd been trying to save the company, that the lies spiraled out of control, that by the time he realized how bad things were, it was too late to come clean. Prosecutors weren't sympathetic. Tanzi had systematically falsified financial statements for over a decade. He'd forged bank documents. He'd created shell companies specifically to hide liabilities. He transferred hundreds of millions to family businesses.
This wasn't entrepreneurial optimism. This was fraud.
And the trial that would determine Tanzi's fate and establish precedents for European corporate crime was about to begin.
The trial stretched over 5 years. Multiple courts, multiple charges. A legal labyrinth almost as complex as the corporate structure Tanzi had created. June 2005, the first major verdict. A Milan judge sentenced 11 people to prison in connection with the Parmalat fraud. Sentences ranged from 2.5 to 9 years.
But Calisto Tanzi wasn't among them yet. His trial was still ongoing.
December 2008, a Milan court convicted Tanzi of fraud and sentenced him to 10 years in prison. He appealed.
May 2010, the appeals court upheld the conviction. 10 years confirmed.
December 2010, a separate court in Parma found Tanzi guilty of fraudulent bankruptcy and criminal association. Sentence, 18 years.
The Italian legal system allowed multiple trials for different aspects of the same crime. Tanzi faced proceedings in Milan for securities fraud, Parma for fraudulent bankruptcy, and other jurisdictions for specific subsidiary frauds. By the time all convictions were final, Tanzi was facing combined sentences that could keep him in prison for the rest of his life. But Italy's Byzantine judicial system had twists, appeals, sentence reductions, house arrest provisions. Tanzi was arrested in December 2003. He spent time in Milan's San Vittore prison, but in August 2004, after about 8 months, he was released pending trial, allowed to return to his estate while the legal process unfolded. It wasn't until May 2011, nearly 8 years after the fraud was exposed, that Tanzi finally began serving his sentence. He was 72 years old. The Corte di Cassazione,
Italy's Supreme Court had reduced his combined sentences to about 8 years and 1 month. With good behavior provisions and age considerations, he'd serve maybe half that. Tanzi entered prison a convicted fraudster. He'd served just over 2 years before being transferred to house arrest due to health concerns. In December 2009, while Tanzi was still free pending appeals, Italian authorities made a stunning discovery. Tanzi owned an art collection worth over 100 million euros. Picassos, Monets, Van Goghs, Cézannes, Kandinskis, Matisses, Modiglianis, masterpieces that should have been seized as assets to compensate victims. But Tanzi had hidden them. The paintings were concealed in friends' homes across Italy. Tanzi denied owning any hidden artwork, claimed it had all been documented. Investigators, tipped off that the collection was being quietly offered for sale, moved quickly. They seized 19 works before they could disappear. Stefano Strini, Tanzi's son-in-law, was investigated for allegedly handling the artwork. The authorities believed Tanzi's family was trying to liquidate assets and hide the proceeds offshore. In October 2019, the collection went to auction in Milan. Rediscovered treasures, impressionists, and modern masterpieces from a private collection. The proceeds went to Parmalat's bankruptcy estate, a small recovery against the billions lost. Fausto Tona, the CFO who'd orchestrated much of the accounting fraud, was convicted and sentenced to prison. Luciano Del Sodato, the chief accounting officer who'd controlled access to the books, also went to jail. Several executives from Grant Thornton's Italian affiliate were convicted for their role in certifying fraudulent audits. They'd known, or should have known. The court found they'd been negligent at best, complicit at worst. Bank executives faced charges too. Luca Sala, a Bank of America executive who'd helped structure some of Parmalat's financing, admitted to misappropriating $27 million in a kickback scheme. He claimed the bank was unaware of his actions. The bank disagreed.
Prosecutors investigated whether banks had been reckless or negligent in helping Parmalat raise billions through bond issues. The SEC and Italian regulators both pursued civil and criminal cases.
Eventually, settlements came. $100 million. Deloitte, Grant Thornton, $4.4 million after protracted litigation. Citigroup, UBS, Deutsche Bank, Morgan Stanley, combined settlements exceeding $1 billion. The money helped, but it didn't make victims whole. $100 million from Bank of America barely dented the harm to 135,000 small investors who'd lost their life savings. The Parmalat scandal exposed catastrophic failures at every level. Auditors, how did Grant Thornton certify Bonlat's financials for years without verifying the Bank of America account directly? How did Deloitte miss billions in fake assets? The answer? They relied on documents provided by Parmalat they didn't independently verify. They accepted forged letters as legitimate. Banks didn't institutions that helped Parmalat raise billions in bonds ask harder questions. Why did they accept that a company with huge cash reserves needed to keep issuing expensive debt? The answer? Fees. Banks made millions in underwriting fees. Asking tough questions risked losing a lucrative client. Regulators, Italy's Consob should have caught this earlier. The offshore structure, 214 subsidiaries in 48 countries, many in tax havens, should have triggered scrutiny. The answer? Resource constraints, regulatory capture, a culture of light-touch oversight for national champions. Credit rating agencies. Parmalat maintained investment-grade ratings until days before collapse. How? The agencies relied on audited financials. If the audits were clean, they assumed the company was solid. Every gatekeeper failed, and 135,000 people paid the price. Calisto Tanzi served just over 2 years in actual prison, then house arrest at his estate, then full release. In June 2022, at age 83, Tanzi died of pneumonia in a Parma hospital. He'd outlived his company's reputation, outlived his status as a respected entrepreneur, outlived the trust Italians had placed in him. His obituaries were brutal. Disgraced businessman, fraudster, the man behind Europe's biggest bankruptcy. His knighthood, Cavaliere del Lavoro, had been revoked in 2004 by President Giorgio Napolitano on grounds of indignity. His Cavaliere di Gran Croce, Grand Cross honor, was similarly stripped. He died a convicted criminal, remembered not for building Parmalat, but for destroying it. And yet, incredibly, Parmalat survived. The company he'd nearly killed lived on. After bankruptcy, most companies disappear. Assets are liquidated, brands are sold off, employees scatter.
Parmalat didn't disappear.
Under Extraordinary Commissioner Enrico Bondi, the company restructured. The fraudulent debts were written off. The bad subsidiaries were closed. The offshore shells were dismantled. What remained was the actual operating business: dairies, production facilities, distribution networks. And that core business? It worked. People still wanted UHT milk. The brand, tarnished by scandal, was still valuable. The products were quality.
Bondi brought in new leadership, cleaned house, installed proper governance, made the company transparent.
In October 2005, a new Parmalat relisted on the Milan Stock Exchange. The shares were offered to creditors and employees first, an attempt to compensate those who'd been hurt by the fraud. The relaunch was cautious. The company focused on its core dairy business. No more football clubs, no travel companies, no TV stations, just milk, yogurt, cheese, butter. The basics. It worked. By 2011, Parmalat had regained profitability. French dairy giant Lactalis saw value, made an acquisition offer.
After a complex takeover battle involving hedge funds and minority shareholders, Lactalis eventually gained control. By 2019, they delisted Parmalat entirely, making it a wholly owned subsidiary.
Today, Parmalat still exists, still produces UHT milk sold across Europe, still operates production facilities in multiple countries. The brand survived. But it's a shadow of what Tanzi built, and it operates under French, not Italian ownership, a reminder that the scandal cost Italy one of its national champions. The Parmalat collapse triggered reforms across Europe. Italy strengthened its corporate governance laws. Sarbanes-Oxley-style requirements were introduced. Audit oversight was tightened. Whistleblower protections were enhanced. The European Union began harmonizing securities regulations. The goal? Prevent another Parmalat, make cross-border fraud harder, improve audit quality. But critics noted that many reforms were reactive, closing barn doors after horses had bolted. The structural problems, complex offshore structures, light touch regulation of national champions, conflicts of interest in the auditing industry remained largely unchanged.
In 2008, just 5 years after Parmalat, the global financial crisis exposed similar frauds and failures. Banks had been hiding risks. Auditors had been missing or ignoring red flags. Regulators had been asleep.
In 2015, Volkswagen's emissions scandal showed that even companies with sterling reputations could engage in systematic fraud. In 2018, Wirecard, a German payment processor, collapsed in a fraud eerily reminiscent of Parmalat. Fake accounts, missing billions, auditors who didn't verify, regulators who looked the other way.
The pattern repeats because the incentives don't change. Executives who commit fraud retire rich, even when caught. Auditors pay fines that are fractions of their profits. Banks settle lawsuits and move on. Regulators get budget cuts. And investors? They keep trusting that this time will be different.
But Parmalat taught us something important, something we keep forgetting. Fraud doesn't require complexity. Simple lies, told consistently by people in positions of authority, can fool almost anyone.
If you enjoyed this episode, click the subscribe button to get notified when we post new content.